explainer. Today we're going to do something a little bit different. We are setting aside all the political baggage of one of the most intensely debated texts in modern history, Karl Marx's Capital Volume 2. We aren't looking at this as a political manifesto. Instead, we're diving into the source material exactly as it's written, as a highly intricate, highly structured economic formula. We are literally going to decode the anatomy of how money becomes more money. Okay, let's dive into this. Here's our roadmap for the journey. We'll start with the oxygen of economics, move to decoding the capital formula, and then walk through the three key stages. Stage 1, the purchase. Stage 2, production, and Stage 3, the sale. Finally, we'll wrap it all up with the endless cycle. Section 1, the oxygen of economics. To really grasp what this text is trying to achieve, we actually have to look at the preface, which was written by Friedrich Engels in 1885. Engels makes a seriously bold claim here. He frames this work not as philosophy, but as a monumental scientific breakthrough. He actually directly compares the history of economics to the history of chemistry. And to make his point, he brings up the discovery of oxygen. And this brilliantly illustrates the dynamic Engels is talking about. Back in the late 1700s, chemists like Priestley and Scheele managed to successfully isolate a new gas, but they were kind of trapped by their old scientific frameworks. They called it dephlogisticated air or fire air. You see, they literally had the substance right there in their hands, but they didn't actually know what it was. Enter Lavoisier. Lavoisier looked at the exact same gas, completely tossed out the old frameworks, and correctly identified it as a brand new element, oxygen. He revolutionized chemistry just by fully understanding what was already sitting right in front of them. Engels argues that a perfectly parallel thing happened in economics. Classical economists, guys like Adam Smith and David Ricardo, they absolutely knew that profit existed. They saw wealth accumulating, but they treated profit as just a simple addition to a price or maybe a deduction from wages. They had the gas, but they didn't know what it was. Engels claims that Marx, much like Lavoisier, didn't invent profit. Rather, he was the very first to fully dissect its anatomical structure, scientifically identifying it as surplus value. And honestly, understanding exactly how that surplus is generated is the key to decoding the supply chains that still run our entire world today. Section 2, decoding the capital formula. All right, this brings us out of the history of chemistry and directly into the primary economic equation that dictates the entire flow of Volume 2. Here it is, the circuit of money capital. Let's look at this neutrally, almost like an algebraic equation we're about to solve together. M stands for our money, C is our commodities, and P is productive capital. Now you see those prime marks, the little apostrophes next to the second C and M? Those indicate an increase in value. And finally, notice the dots. In this specific formula, the dots indicate a physical interruption in the circulation of the market. Let's break this whole thing down by looking at the very first stage of the circuit. Section 3, Stage 1, the purchase. Every cycle of capital has to start somewhere, right? And it starts in the marketplace. So the crucial point is right here at step 1, M to C. The capitalist advances a sum of money, that's our M, into the market to purchase commodities, C. But the capitalist isn't just buying random items like a TV or a sandwich for their own enjoyment. They are buying the highly specific ingredients required to make something new. To do this, that initial money splits into two very distinct purchases across two entirely different markets. First up, they buy the means of production, symbolized here by MP. We're talking machinery, raw cotton, factory space. Second, they buy labor power, symbolized by L. This is the actual human effort required to run those machines. And both of these are bought simply as commodities at their standard market value. Now, the source text points out a truly vital historical prerequisite for this formula to work on a mass social scale. For labor power to be widely available to purchase as a commodity in the first place, you need a society where the workers are completely separated from owning their own means of production. Think about it. If a worker owns their own loom and their own cotton, they just sell the finished cloth themselves. They only sell their time and labor power if they don't own the tools to make the final product. It's a foundational, structural dynamic that still defines the modern labor market today. Anyway, with both the workers and the machines successfully purchased, the capitalist is ready to leave the marketplace. Section 4, Stage 2, Production. We are now officially transitioning out of the public marketplace and stepping through the doors of the factory, where the actual creation happens. Let's move to and see how this builds into the second step, the P stage. Notice those dots before and after the P. As we mentioned, this indicates that market circulation has officially paused. The buying is over. Productive consumption has now begun. Inside the factory, it's almost like a kind of economic alchemy takes place. The capitalist takes those two commodities they just bought, the raw materials and the human labor, and consumes them together. The labor is physically applied to the materials, and as this happens, an entirely new commodity is forged. Here is the kicker. Because the labor applied creates more value than what the capitalist originally paid for that labor in wages, this new commodity contains surplus value. It is now C prime. It is inherently worth more than the sum of its raw parts. Let's ground this abstract algebra using a very specific example provided directly in the text. Imagine 10,000 pounds of yarn. Say a capitalist advances 422 pounds. They spend 372 pounds on cotton and the wear and tear of the spindles, and then 50 pounds on wages for the spinners. Inside the factory, the spinners get to work. They transfer that 372 value of the raw materials directly into the yarn. Sure, but they also add 128 pounds of brand new value through their active labor. So the total value of the finished yarn is now 500 pounds. Subtract the 422 the capitalist originally spent, and boom, you have 78 pounds of pure surplus value. That 78 pounds is the economic oxygen. It is the new value generated entirely inside the P stage. Section 5, Stage 3, the sale. But listen, having 500 pounds worth of yarn just sitting around in a dusty warehouse doesn't do the capitalists any good at all. We have to move the narrative back out of the factory and into the marketplace for the final transaction. We are now at the third and final step of the formula, C prime to M prime. But this is exactly where the risk lies. The newly enriched commodity has to be successfully transformed back into money. This is a critical moment of realization. The capitalist returns to the commodity market, but this time as a seller. They absolutely must successfully sell the total mass of the commodity to actually realize that 78 pounds of surplus value in the form of cold hard cash. If they only manage to sell a portion of the 10,000 pounds of yarn, they might only make back their initial 422 pounds. To realize the true M prime, the expanded money, they have to sell the full C prime at its real value. Now, what's really interesting about this is a fascinating exception pointed out in the text, citing the economist A. Chuprov. Think about the transportation industry, like a railway. What is the commodity a railway actually produces? Well, it's the change of location. But you can't box up a change of location and sell it later in a market, right? In transportation, the useful effect is consumed during the exact process of production. Therefore, the formula actually skips the C prime stage entirely. It jumps straight from production to M prime because the locomotion is paid for and consumed the literal moment it happens. Pretty wild, right? Section 6, the endless cycle. Whether we're talking about yarn or railway tickets, once that expanded money is finally realized, the formula is complete. But what does this actually mean for the broader economic system? The text makes it incredibly clear that this is not a straight line. It is an expanding loop. M prime is the end of one circuit, yes, but it immediately becomes the starting M for the next, even larger circuit. The capitalist doesn't just take that 500 pounds, pack up and go home to relax. No way. They take the 500 pounds and advance it again to buy more means of production and more labor to create an even larger C prime, to yield an even larger M prime. Money-generating money becomes the sole, overriding driving force. It is an endless cycle of capitalist accumulation. Which leaves us with a profound, highly analytical question to end our explainer today. If the very nature of this economic formula demands that M prime must always become the starting point for a new, ever larger circuit, is there a mathematical limit to this endless accumulation? What actually happens when the formula simply cannot expand any further? It's a question that naturally arises from the math itself, and one that is absolutely essential to chew on as we view the world through this highly structured lens. Thanks so much for joining me on this explainer, and keep questioning the formulas that run our world.